After successfully pushing for the capping of interest rates, legislatures led by Kikuyu MP Kimani Ichung'wa are at it again. This time round, they want to ensure Kenyans access loan facilities at interest rates strictly not more than 4% above the central bank rate. The law currently caps interest rates at 14%.
We want to make it that all charges that relate to a loan application become part of the interest charge of 14%, that the maximum cap of 14% is inclusive of all charges relating to a loan application.
If adopted, the new bill will also see public entities only deposit funds and invest surplus funds in government-owned banks. These are banks which government holds at least a 20% stake in them. This move aims at taming the tendency of government borrowing its own funds, often deposited in commercial banks by its agencies and at higher interest rates.
The PS Treasury and the CS Treasury can sit, and since they're also represented in the boards of these banks, they can sit with those few banks and negotiate for an interest rate even below 6%. And therefore that brings down the cost of borrowing for government. And not just government, even to the common mwananchi, the SME sector.
The changes, Ichung'wa argues, target to protect ordinary borrowers and small and medium-sized businesses that are currently finding it hard to access loans from commercial banks who deem them as risky borrowers.
Because when we restrict the number of people then who are lending to government in terms of how many commercial banks are able to lend to government, the rest of the banking sector will have no other option other than to lend to you and me and the business community. And that's how we spur economic growth and development in the country.
Though the bill's objectives are justifiable, experts say it is still too early to introduce changes on an act whose impact is yet to fully be felt.
And an important part would be to check to what extent has the capping that happened in 2016 been enforced. So have banks complied to it? To what extent have they complied to it before coming back and possibly looking at avenues of introducing even fees for review of loans as part of the 14% maximum levy.
The recently enacted capping law has already seen lending to the private sector shrink. The proposed changes, experts argue, may further compound the situation in the banking sector, given that banks account for close to 52% of government borrowing.
So if banks stop lending to government, then government needs to figure out how to plug a hole of more than 50% of its total treasury bills and treasury bonds. I don't think that's an overnight solution.
The debate has now attracted the attention of the International Monetary Fund, that's calling for the removal of interest rates controls, saying they are detrimental to the economy. Reduced access to credit, a decrease in profitability for banks, as well as a complicated monetary policy regime are some of the reasons why the IMF wants capping done away with. Are we going to enter a regime where interest rates are going to be low and low in a sustainable manner?
The only sustainable way of bringing down interest rates is to make sure that you reduce government borrowing from the domestic market. Therefore, with this bill, I can assure you, it will be sustainable.
The new bill, which will no doubt intensify debate around interest rates, is set for publication soon. Patrick, a Gunza Citizen, live at 9.